Well, the US Employment and Institute for Supply Management reports for August could push the Fed towards further quantitative easing at the upcoming FOMC meeting on Thursday. But what does this mean for local investors? On the desk, as I said, Wayne McCurry, Momentum Investments, and joining us from our Cape Town studios, Alwyn van der Merwe from Sanlam Private Investments. As I've said for some time now, and Alwyn, let's start with you in Cape Town. Policy making is certainly giving direction to markets and what is happening in the equity space. What are your views on Thursday? Is it really a big day in terms of market direction globally? Are you anticipating that it will be?
Yes, I think so, Bronwyn. I think the whole process started when the ECB and Super Mario came out with his announcements last week, and you could see how the market just lapped up the positive news and the decisive action that we've seen from the ECB. You've mentioned the poor employment numbers, and of course also the ISM numbers that clearly indicate that economic momentum is coming off. And I think the whole market just expect the Fed to take action. You know, I don't think it will do anything to the economic reality, but it can certainly do a lot in terms of investors' confidence. And we saw that happen to our own market in terms of the strong performance from commodity shares and of course also commodity prices. So I think the market is primed for that. Should you not get decisive action from the Fed, of course the opposite will happen. If you get disappointment relative to expectations, I think the market will take that quite badly.
Alwyn, just to ask you, as I understand it, Ben Bernanke has been very keen on keeping the consensus at the FOMC together. So he's very hesitant to make decisions without the full consensus of his committee. Why do you think there's been no QE3 yet, despite the fact that we've seen declining levels of economic activity in the States especially?
Yeah. Warren, I think you've got to look at the time frame, or that is simply just my perspective on it. If you look at the economic performance from the US in the first quarter at least, and even in the second quarter, you know, if you look at three indicators, for instance, you look at employment growth. Although employment growth was rather lackluster, we still had positive employment growth in the States. So, you know, that wasn't disappointment. I think the last 2 months the numbers were rather disappointing. The other very important number that you've got to look at in the US, of course, is what is happening in the housing market. And if you look at house prices, if you look at the number of months that houses stay in the market before it gets sold, and you just look at the activity levels in the housing market, it certainly looked much better compared to a year ago. And then finally, it's just liquidity measures in the States. And I think if you look at liquidity measures in the States, that also looked a bit better. So if you look at those three factors, I think the Fed just wanted confirmation to see that the economic activity is indeed losing momentum. And therefore, the time is ripe now for the Fed to take action. I don't think it was that clear cut previously.
So brace yourself for a market rally come Thursday.
Now look, you could get it. You know, I'm not sure that things have deteriorated enough in the US to justify a QE3. Look, Europe, we know there's trouble there. I mean, and things have not really improved in Europe. But the US, although it's not good, maybe is not in quite as dire a set of circumstances as what Europe is. And I mean, the market will love QE3, but as Alwyn quite correctly said, it doesn't put money in consumers' pockets. It doesn't by itself create jobs. It just creates more liquidity in the financial sector. But also, quite correctly, as Alwyn said, it's very good for sentiment. It's extremely good for sentiment.
Just on that note, Wayne, obviously the Chinese have now taken the initiative and launched that $150 billion infrastructure spend. In addition to what they're already doing, obviously. What's your take now on the shift of power? Do you think this move by the Chinese is kind of the last, almost the last, they were waiting to see something coming out of the States and they've now decided to take the initiative? Or how did you understand their actions?
China, first of all, China is the only major economy in the world that still has the ability to stimulate their economy. Interest rates are still relatively high, even though they've come off slightly. And of course, the government's own finances are in a far better shape than Europe as a whole and the US in particular. So they are the only economy that can stimulate. Now, of course, they had an inflation problem a year or two ago, hence higher interest rates to try and bring growth and inflation down. And by and large, up until the last 2 months, they were quite successful in doing that. But with Europe slowing, with the US quite poor, their exports have disappointed, and quite frankly, their internal consumption has also disappointed. So what's happened is China is slowing down more than what the Chinese government wants. Hence the infrastructure, but maybe even more importantly, the cutting of interest rates in China. So you can argue the only country, not argue, it's a fact, the only country in the world that can get the world going again is China, and they seem to be doing it. But what really worries me in China is food inflation once again. Global food prices are back up at their previous high, mainly because of this drought in the US, and the Chinese economy and the Chinese consumer cannot tolerate high food inflation.
Alvain, does that worry you about China, high food inflation, and the impact that it will have on the Chinese consumer?
Yes, I think Wayne is dead right, but for me it is a kind of a cyclical factor. It's not a,
Yes.
I don't see it as necessarily as a structural factor. And I would like to think that the authorities will look at the bigger picture when they formulate policy in China. You know, if you just look at the entire Chinese situation, as Wayne correctly says, that they are indeed in a position where they can stimulate the economy. And you must remember that the latest announcements came on top of already quite ambitious spending pattern that they've announced last year when they announced their 5-year economic growth plan. So they still plan to build 10 million new houses in the next year in terms of low-cost housing. So those projects still continue. So although the rate at which they are expanding is perhaps slowing, one must understand that activity is still going on. And again, you know, if I can refer back to the policy actions, remember it was also quite a decisive move by the Chinese government to address the whole issue in their property market. So when the property market started to slow, it was as a result of policy action taken by the authorities. And I think what they're seeing now is that the property market, the so-called bubble that we've seen there, that is being addressed to some extent, so they can actually put the foot on the accelerator now should they like to do it, despite the fact that food inflation, as Wayne said, is likely to go up and will have an impact on the overall inflation rate as well.
Alvain, just on that note, if I recall correctly, you undertook quite an extensive trip to China last year, and you noted the policy leaders had set out this shift in policy where they wanted to move from an investment-driven, export-led economy to more inwardly stimulated. How do you reconcile this infrastructure spend that they've announced with the plans that they want to transition the economy to more inward growth?
Look, Warren, I think it is actually quite easy to do it. When they've announced that plan or the intention, they've clearly said that's a longer term plan. And you know, in the shorter term, they will address the cycle as they see fit. So I don't think that is necessarily a change in the plan. So that is the first point. Secondly, you know, although they wanted to shift the focus to internal consumption, they certainly didn't argue that they're going to spend necessarily less on investment. What they wanted to do is actually just to make sure that they're not that dependent on spending by the Europeans and the US consumer to support their economic growth, because you know, they, as you correctly I think indicated earlier, that they want to be one of the economic powers in the world, and they need to depend on their own consumer to do exactly that. So I don't think it's a change in plan. I simply just think that they are addressing the problem the way they see it at the moment, and I think over time you are likely to see that the consumer will be the Chinese consumer will be a more important part or a bigger part of the total cake or economic cake of the Chinese economy.
Let's address the elephant in the room. Do we trust the Chinese economic numbers enough to make robust economic or
Yes.
investment decisions on the back of them?
Yes. And not necessarily the Chinese numbers themselves that come out. It's numbers that the Chinese government has got no influence over via, let's call it in theory, manipulation of the numbers. They can't manipulate the oil price. They can't manipulate commodity prices. In other words, the price is what it is, and it is mainly dependent on actual Chinese consumption, but that's actual consumption. Import-export volumes are very difficult to fudge. Electricity usage is very difficult to fudge. So we all know the stories about Chinese bookkeeping, and didn't get that name for no reason whatsoever, but there are numbers you can check up, and you can just see it. I mean, the most simplistic way of looking at it is look at the metals prices, look at the oil prices. You know, if China was in deep trouble, oil will be $70, it wouldn't be $150. You know, the metal prices, iron ore, would be way lower than what they are. So although metals are off about 25-30% from their peak, they're still not as high as what they were in 2008. You know, it's not as though they've collapsed out of sight.
So what do you, on that note, Wayne, what do you anticipate from the Chinese economy? That many people
we'll
talk
be
about
okay.
a soft landing or hard landing?
No, we'll be okay. They have no country wants a hard landing for their own economy, and they will do whatever is within their power to stop a hard landing. Now, other countries haven't got anything in their power. There's nothing left. But China, there is a lot left. And I mean, America was, let's call it the Western world, but it was basically America was the growth engine for the 5 decades to 2000. American consumer and American debt. The growth engine for the next 5 decades will be the Chinese consumer and Chinese debt. So I mean, the Chinese are becoming Americans to a large extent, and that'll be the growth engine because they've got very little debt. The Chinese consumer has got incredibly little debt at the moment, but the economy will probably take another decade to go from an export-orientated to a domestic consumption-orientated economy.
Alvin, there obviously Wayne saying that there's enough external validation to the Chinese economic numbers to trust them. Do you have any concerns? Of course, there are questions being called in about the level of debt of the Chinese municipalities.
Yes, there are so many numbers that you can check, but I think in essence I must agree with Wayne. You know, if you look at the activity levels, as Wayne correctly says, you know, the commodity prices can't be as high as they are at the moment if it wasn't for demand coming from somewhere. And the two areas where you will get demand for commodities, China is China is the biggest one. I think for most commodities, on average, they use about between 40 and 50% of the world's commodities. And of course, India is the other region. You did right when you referred to the municipalities and the debt of the municipalities. Again, there are so many numbers floating around, so one has got to be careful not to come to certain conclusions. I guess that is a risk, but one must understand if you go there, the municipalities, unlike the municipalities in South Africa, they've got real assets. And what they do when they spend money and incur debt, they do it on assets that actually generate income. And that is not what we find in South Africa. Of course, it also brings a question mark around the banking system in China. But again, I think, although it is a risk, I think it is more often than not it is overplayed. So I would certainly, in general, agree with Wayne. The other point that I would like to highlight on the Chinese numbers and the growth rate, as Wayne says, you know, the government will try its best to avoid a hard landing. The one thing, if you travel to China, and I've been there a number of times, and without exception, I walked away with that impression that it is extremely important for government to make sure that they keep the social order intact. In other words, they don't want to encounter a situation where you have social unrest. And the way to do it is to ensure that people have got jobs and that people have got money in their pocket to spend and buy food and have housing. And the activity levels really is geared to do exactly that.
Let's head into a short break. More Investment 360 right after this.